Well, I want to welcome Dirk Walker to my second episode of BLUECAST, podcast that I started just to talk about real estate, careers, my friends, life. I'm really excited to have you, Dirk, here.
Happy to be here. Thanks for having me.
You've been a long time guru of financial news and topics. And I thought it'd be really relevant for you to come in and kind of talk about the real estate market, the financial markets, and the current conditions and what's going to happen and what's moving forward. Let's just start by talking about our history.
Okay.
I think we've worked together probably for 10 years now.
Yeah.
About 10 years, right? We've been business partners with Brian and Todd. Just give me a little backstory about your personal history, where you started, how long you've been in the business to get here.
So I started off in the banking world with a company called Washington Mutual, which a lot of people giggle about because of WAMU and its epic departure from the marketplace.
And when was that?
When was I there?
Yeah, when did you start?
I started at Washington Mutual in 93.
1993. That's a long time. Really?
Yeah.
I didn't realize you went back that far.
Yeah. So I was at Washington Mutual for about 4 or 5 years. And I went through their...
What were you doing there?
Yeah, I started in their management training program.
Okay.
So kind of worked my way up through there, managed a couple different bank branches in Oregon as well as in Utah.
I had no idea that you were in Oregon or Utah.
Yeah.
And it went back that far.
Yeah.
For some reason in my mind, I thought you were like 1999, 98. I had no idea so you're on the banking side then?
Yep.
Okay.
I was in the branch management.
Okay, cool.
Yeah. I took a little bit of a hiatus out of the banking industry and got into sports marketing. Kind of thought that was going to be my life calling. And after a couple of years of really not making a heck of a lot of money at it, I had moved back to Colorado, and I just have such a deep family history in real estate. And my dad was in real estate. My father-in-law was in real estate sales. I just knew a lot of people in real estate.
Culture.
Yeah. So I just knew people, and I was like, the mortgage side, I always really enjoyed the mortgage side when I was at Washington Mutual.
Right.
So I got back into the mortgage business when my daughter was first born. So nothing like going from making no money to being 100% commission straight out of the gate.
I know that feeling. Yeah.
So, and then it was right at the start of a great refi boom in 2000.
Yeah.
And so it really just, I never got out of it.
Wow. So you went from being a banker, right, and managing banks, kind of being in the training program, to sports marketing, then back into banking and mortgages. Got it. And then where did you work when you started in 2000? Were you still at Washington Mutual, or did you find a different company?
No, since I was back here in Boulder, I was working for Liberty Home Loans.
Okay. Was it Don Sprague?
It was, yeah.
Yeah.
And that's where I met Christy, who we've been together with ever since then. So.
And for those of you that don't know, Christy's kind of our production manager. She kind of runs our whole process for our files.
Yep. So that's like 24 years of knowing Christy.
That's crazy. And she must have been pretty young at the time.
Yeah, she was. Yeah, she was like a little. Yeah, she was like a kid almost.
19 or something. 20 years old.
Right?
Yeah. And then from then, I know that you and I both had worked for Ariel and Mel at Premier. Mm-hmm. Did you go from Liberty to Premier, or?
Yep.
Okay.
Melanie recruited me away from Liberty.
In like 2002?
Yep, exactly.
Oh, cool.
Yeah, exactly. So I was there, and then I was with Premier for almost 8 years.
Yeah, because you left like pretty much a week before I had started working there.
Yeah,
right?
I think
literally like a week. I think I took Josh Dutton's office, or one of them, because your office is right next to Ariel's, right? And I kind of
I think Ian actually came in and took my office.
Oh, Ian took your office. Got it.
Yeah.
Great. So let's get down to the dirt. Let's get down to what you think the market conditions are. And the first thing I want you to do is really explain why you think the market's going to turn and why rates are going to get better. And I know that you're going to touch on the inverted yield curve and those kind of things. And I know we've been talking about this for a long time with realtors and our teams. But can you start by just kind of giving me an overview of what the current market conditions are and what you think your projections are? Obviously, we're not going to hold this.
Yeah.
But I mean, and then why? And then we can kind of talk about the details and the devil in the details
Sure.
of why you think that it's going to look like.
Yeah. Let me take kind of a step back first before I jump in there, because I'm
I want
kind
you
of
to fully explain it, because I think a lot of people that are going to listen to this show aren't really going to have the knowledge base. So try to be as detailed as you can, because I think it's going to be important.
Yeah. I'll keep digging with me as well. I love these kinds of conversations. And my step back is that I was an econ major, and I really just kind of am a econ geek. I've always kind of tracked economic data, looked at, economic decision making for both the consumer as well as just how economics affect, our marketplace. And so it's been really a fun way to dovetail our business with the econ side of it.
Yeah. And so what kind of data do you follow now?
I follow a bunch of different analysts.
Yeah.
And so I really just dig into a lot of the macro data, which is like, we'll touch on it here, I'm sure, with the employment data that came out last Friday.
Right.
Inflation data, anything that really has an impact into the interest rate world.
Right. And so what do you think the outlook is? And we're kind of like in a higher rate environment now. We've kind of been in a higher rate environment for the last year and a half. It's starting to get a little bit better. What do you think? What are your globe projections?
We had an unprecedented rate spike, and being in this business for as long as I've been in it, nothing like that has ever occurred before.
Right. I don't think, for any of us.
And so, kind of just to see how we're going to come out of it, I think is also going to be probably somewhat unprecedented.
Do you know exactly how fast? What was the rate percentage change in the Fed? I don't know exactly what those details are, but it had to have been like 3% or something raise in Fed funds rate.
Yeah, I think it was almost 4% in 6 months or something like that.
Wow.
So it was the fastest and highest rate hike combination ever
in history
since
they started recording.
Yeah. So that all happened last year, which basically dried up both the real estate market as well as the mortgage market.
Right. And then how does the Fed funds rate? Because I think there's a real misconception when clients call us, because they're like, hey, they're raising rates again, the Fed, and the explanation of how. Can you explain how that actually affects long-term interest rates?
Yeah. So the Fed doesn't have their finger on the switch
rate, right?
for mortgage rates.
Right.
So what the Federal Reserve is doing is they've got kind of the initial trigger to kind of allow rates to move up or down.
Right.
And so when they start moving rates up, what they're doing is they're trying to hope that there's a trickle-down effect to all other rates.
Right.
And so, it really affects the consumer first, and it also affects banks.
So you mean it affects the consumer because the Fed funds rate is really tied to things like HELOCs, car loans,
credit cards,
like that stuff, cards. That stuff moves up super fast, right?
Exactly.
And the difference between that and like a long-term, like a mortgage bond, is it because? Can you help explain?
Yeah.
Like what
they're doing is they're basically signaling to the market that, hey, we're worried about inflation, let's say. Yeah. So they're worried about the market heating up too quickly. Right. And so when they start raising those rates, what they're doing is they're also signaling things like the stock market and bond market that, hey, things are too hot and we want money to move around into different sources. So with their influence in pushing rates up, what they're also signaling to the bond market is, hey, you too also are going to have to push those rates up. We want more money to go into safer long-term investments. And so those rates start going up. More money starts piling into those vehicles.
So there's no direct correlation between the Fed funds rate and mortgage rates. but because of them inflating, is it the bank-to-bank lending? Is that what the
Yeah, it's overnight loans. It's an overnight loan
overnight loans to different
to the
banks.
major institutions.
So if they're
yeah.
paying more, then essentially it's going to drive.
Exactly.
Yeah. Okay.
So then what's going to happen is that they're indirectly affecting things like the stock market and the bond market being the one that is going to have that change in mortgage rates.
And what else, for people that don't know, what is the 30-year mortgage really related to?
It's related to to mortgage-backed securities or mortgage bonds, and so every single lender across the country is going to package up and sell their loan. So I do a loan for you.
Yeah.
What's going to happen is that loan ends up ultimately going into a portfolio that gets sold into one of the major agencies like Fannie Mae or Freddie Mac.
Right.
From there, it gets packaged up again and then sold into Wall Street into a giant portfolio or a bond.
For like a servicing portfolio.
No, just a bond portfolio,
Okay.
a trading portfolio.
Okay.
That investors, like institutional investors, can go in and buy, or individual investment hedge funds and things like that.
Long-term yield.
Exactly.
On the
Yep.
mortgage. I want to touch on like the 10-year treasury, right? Like, so how exactly is a 10-year treasury? Because I've long been an advocate of being like, look, as the 10-year treasury moves, so does mortgage bonds. So if they're not really sold as 10-year treasuries, right?
Mortgage bonds?
Yeah, the mortgage bonds. But how do you know how that's related to each other?
They're so closely related because oftentimes what the trading desks are doing is they will use the 10-year treasury as a hedge against a mortgage bond.
Okay.
So 10-year treasury has a significantly higher level of safety and security because it's backed by the full faith of the government.
Right.
Whereas a mortgage bond is backed by a real estate transaction.
Okay.
So that's kind of the distinction between the two.
Right.
And when a mortgage bond is placed, or like when we go to lock a loan,
Right.
they're locking it into that mortgage security, but they're taking a other opposite position in a 10-year treasury
Oh, I got it.
to back up that lock. That's their hedge.
So it seems like it's like the safety to the mortgage bond, basically.
Exactly.
Okay.
Yeah. It's a good way to think about it.
All right. So what does that look like now? Like, why have the treasuries gone up so high? Why are what is driving the excessive climb in mortgage rates?
Well,
And 10-year treasuries.
yeah, and that is a combination of a couple things,
Right.
and probably even a number of things. Really, the big thing is inflation and the cost of funds and that velocity of money that's.
I'm
going around.
asking like more on like a granular level. Like what do you, is it like fear of not being repaid? Is it like what is it? Like what do you think is like driving? Like we're gonna get into the inverted yield curve in a little bit, but I'm like, I know there's other reasons why, not just because of inflation. Like, is it because the cost of it? There's no buyers for it. What is that look like?
Yeah. I'll give you my econ world. It's supply and demand.
Okay,
It's
that's
pretty
fair.
much really what it boils down to is that there were too many mortgage bonds that had been issued out there at these low interest rates, and so the Fed, when they went through their quantitative easing perspective.
Okay, side note, what is quantitative easing?
Okay. So quantitative easing is the Federal Reserve going out there and saying, hey, we want to actually stimulate the economy, so we're going to go buy these mortgage bonds.
Okay, so they were buying up a lot of mortgage bonds.
Exactly. Because there weren't a lot of other investors
over
out
COVID.
there.
Okay,
Exactly.
got it. Okay.
So they're buying these bonds in, and they're driving up these bond prices and putting these rates down.
Right.
So then what ends up happening is that they own all of these mortgage bonds. Okay. So they've got this huge portfolio, and now they've got to figure out, well, what are we going to do with all of these bonds that we own?
Right.
And so at some point they've got to start offloading them.
So so they've been in addition to raising the Fed funds rate, they've been issuing bonds,
selling bonds.
The bonds that they collected over the 2000 or 2020 COVID.
2020, 2021, yeah.
2019 to 21-ish.
Yep.
Right?
Yep.
And now we're sitting in 24. So and how long has it been? Like a year and a half they've been issuing?
Yeah, since about early 2023.
And so that's another factor of why the rates.
It's a big factor. Yeah, because they're trying to get rid of all of that. And so they're flooding this market and there's no buyers for it. So it has this kind of compounding effect between the market saying, we can't absorb all of this.
Do you think that all the buyers that are out there would rather buy the paper that the Fed's selling at 2.9% or new paper at like 5%?
Oh, of course they'd rather buy the higher rate
because it's got more yield on it.
Yeah.
And then I'm just going to kind of jump around a little bit, but
yeah.
So what about the security part of, because I know one part of like us selling mortgages on the secondary market is built off of how soon they're going to refinance into a lower rate. Like how long is this paper going to stick around? Do you feel like there's like a market for these people that want to buy these notes at like 2.5% because they're more securitized? Like they're going to last longer?
Yeah, they are going to stay on the books a lot longer.
But there's not a good enough yield?
Yes, especially in a market where, you can go get a 12-month CD for, 5.5%.
Right. You can just get a treasury.
Yeah.
What we were talking about earlier.
Exactly.
Right?
It's
safe. The counter to the mortgage bond is a treasury, and the treasuries are paying at 5%.
Yeah. So why buy a maturity that still has 28 years left on it at 2.5%, or go buy 12 months safe and secure at 5.5%?
Got it. I didn't even think about that until we just started talking about it. Like you could go and buy a 12-month treasury and make 5% on your money, or right. That makes sense. And we're talking huge investors that are buying millions and millions, billions of dollars worth of paper.
Yep.
It's either a treasury or mortgage-backed security.
Exactly.
Okay, that makes sense.
Yep.
So, what are the indicators? So we kind of just got off on a tangent. So we were talking about
why these rates?
Why the rates are going up, and so what else do you think are factors before we move on?
So really, it just to me it does come down to a supply and demand, and with rates of been down so low for so long, we had so many buyers out there buying real estate. And now we've got a locked up real estate market.
Right.
And it's just, we've got an illiquid real estate market.
Right.
And so,
on both
we've
ends,
got
right?
prices.
The financial side of it. Because nobody wants to issue a mortgage-backed security that's gonna get refied off their books sooner than later.
Yeah.
And you have a bunch of people that are sitting in their houses at 3% mortgage rates or whatever, 2.5% to 3.5% mortgage rates that are like, I'm not going to go buy a new house, because it's going to be a 6 or 7%.
Yeah,
right?
I can't afford it, or I'm worried that the price of the houses. There's a lot of consumer fear that prices of houses is going to go down. But
I didn't even think about that part.
Yeah.
Cool. So let's talk about what your feelings are on like an upcoming recession and why you feel that way.
Mm-hmm. Market prognostication.
Are you in the soft landing camp? Are you in the hard landing camp? I mean, I watch plenty of CNBC every day. So it's like I watch talking heads that get up and talk about both sides of the coin, right? Do you feel like we're going to have more of like a soft landing coming out of this, or?
I don't have a really good answer. I can make a case for both. And
for the listeners and watchers' sake, let's make a case for both. Let's talk about both. So let's talk about a soft landing first, and then we'll talk about complete disaster second.
So the soft landing notion would be that we don't really have a huge problem with our employment markets.
Right.
So as long as we see job growth and steady employment and not a huge amount of layoffs, and we can continue to get this inflation number come down,
right?
Yes.
Yeah.
So that's kind of the sweet spot here, is if we can get the inflation in control and keep the employment market strong.
Right.
Friday we had a really strong. We had nearly twice the amount of new jobs created than were expected.
Right.
So that information is not good for helping with the inflation numbers.
Right.
So a softer employment market would be like less than what we were expecting. Right. So, right now we're showing signs that the employment markets are strong.
Right.
Anecdotally, we see, layoffs at big companies all over the place.
That's what I don't understand when I watch that stuff. It's like, I see all these numbers and layoffs, but then, I mean, I feel like it's a little bit of like frictional unemployment or something. Like, yeah, they're adding jobs at McDonald's, but like high tech, high paying jobs are gone.
Yeah.
Like, you know what I mean? Like, what do you think that is? I mean, what does that?
It seems like it's gonna come and fold into the actual data at some point.
Right.
And that's where I think the opposite case is gonna you can make this case that it's a storm that's brewing that no one really kind of starts seeing.
I've been talking a lot about with a lot of people about like credit card debt numbers, car loan delinquency numbers, like all these like signs of like weakness, and maybe that's because
depleted savings,
right? That's another one,
and
that's why I feel like that, and is like a telltale sign of like people just don't have the money they had a couple years ago, right?
Yep.
They're not spending the money they were a couple years ago, even though consumer confidence is like super high.
Right.
Like I don't like that data just doesn't line up. So for me, it's kind of been a little bit of like, when is the shoe gonna drop?
Yeah.
Right?
Yeah.
Like, and I know. Let's talk about the inverted yield curve, because I think this is something that we've kind of in our branch have been we had presentations last year on it with realtors. It's like we've been kind of like raising the red flag.
We talk about it a lot with our clients.
So can you explain to the audience what the inverted yield curve is and how long that's been going on, and what the history of that is?
You bet. So a traditional looking yield curve means that short-term interest rates are lower than long-term interest rates.
Treasury, right?
Yeah, I mean, it could be 1 year treasuries, 2, 3, 7, 5s.
Right.
So the lower end of the yield curve would have a lower interest rate because your money's tied up for a shorter time frame. And you'd want a higher rate of return if you're going to invest that money for a longer period of time.
10 years.
So that's just a normal 10 years, 20 years, 30 years. Yeah.
Right.
So
safer, longer.
Exactly.
Lower.
So the big metric that most people use is this spread between the 2-year treasury and the 10-year treasury.
Right.
And they say, well, once the 10-year treasury has a lower interest rate than the 2-year treasury,
which means what? You can put your money in a treasury for 2 years and make more money off of it than you would on a 10.
Exactly. So when that dynamic has occurred historically, going back, you can go back the last nearly 10 recessions that we've experienced, 9 recessions, and all of them have success. Anytime that you've had that inverted yield curve, you've had a recession.
Right.
And the longer time frame that you've also experienced with that, the greater chance that it's also going to occur as well.
Is it the longer the recession is, the deeper the recession is? Is there any correlation in data when it comes to that kind of stuff? So we've had an inverted yield curve with the 2 and the 10-year treasury, since we're going to use that as an example, for what, like a year and a half or 2 years?
Yeah, it's been a long time.
It's been a while, right?
Yep.
So in reviewing the data, which I know you have because I have your presentation and I've given it to people, and I'm just trying to think of those spaces on that chart that you had showed.
Yep.
Like, so what, looking, just kind of going back into memory, does it feel like the longer that those took place, the deeper the recession was? Or
no, there were a couple times like back in the 80s when it was inverted for quite a long time.
Right.
But that didn't necessarily indicate how long it was going to last. Just that the longer it happens, the higher probability that it's
probability. But was there ever a time that it was inverted for a significant amount of time that there wasn't a recession?
Not that comes to
so never before,
memory. Right?
And we have an inverted curve for the last 2 years.
Yep.
Never in history, those that have been inverted, we haven't gone into a recession.
That is correct.
It's funny how you don't hear people on TV talking about that.
No.
Right?
No.
Like, I don't. When I'm watching CNBC and financial news, like, I don't hear people saying, "Hey, this has never happened before." Because everybody's talking about a soft landing, but nobody's saying we've never come out of an inverted yield curve and not gone into a recession.
Exactly. So that's the other end of the spectrum. Is like we see a strong job market, which could yield to that soft landing, and then you see the inverted yield curve, And you're like, wait a minute, that's never happened before. So how is that going to actually
So
occur
it's
this
safe
time?
to say we are in uncharted territory.
For sure. Exactly. And that's why I go back to this whole thing is like, when we had this uncharted increase in interest rates so quickly,
Right.
that it's going to be uncharted on the other side of this whole thing.
Yeah.
And I think mostly where we're going to see is this movement in the marketplace where all of a sudden rates feel really good for, maybe a few weeks, and then all of a sudden it's taken away from us.
Right. Like what happened in the last couple of weeks.
Yeah, exactly.
Do you feel like, what's your gut tell you? Like we talked about, like, we were just talking about, like, okay, there's two sides to the soft landing. What does your gut tell you? All the data that you're looking at.
It's funny. You've probably heard the same saying, stay alive for 25.
Is that the same? I've not heard that saying.
And so, which essentially is saying, we're going to still have a hard market in 2024.
Okay.
And then 25, it starts
this is the new mantra already.
Yeah,
for
exactly. Instead of like, date the rate, marry the house, I think it's stay alive till 25.
I had and somebody just told me, and I don't remember if I brought this up with Ian or not on the last podcast, but somebody just told me, it was Brett with the title company that said at the end in December there was 22,000 mortgage broker licenses or mortgage banker license, whatever, issued in Colorado, and come January 1st there was 16,000.
Wow.
Isn't that
so
crazy?
Like 8,000 attrition?
We lost 8,000 last year in mortgage bankers in the state. So when you say stay alive to 25, it's kind of reminded me of that data point that Brett had brought up to me in a conversation I was having on the phone with him. So you think you think we're going to have a sustained higher rates for?
Yeah, I think it's still going to be a challenging market. I think we're probably still going to stay in this, probably capitulate back and forth between 6% and 7%
for the whole year.
For the year, yeah. We're going to see pockets where it gets really good, and we're going to see pockets where all of a sudden it's going to turn real quickly on us.
And if you were a betting man and you had a crystal ball, when do you think actually, if we did go into a recession, when would that be?
Well, we might be in it right now.
We just don't know it.
We just don't know it.
How does that work?
So a recession is measured by a negative GDP number, a quarterly negative GDP number.
Okay.
So we had just
remember
recently.
What our last quarter?
Yeah, it was strong. It was actually came in at 3% positive, but those numbers get revised.
Revised. Yeah.
So often.
Right.
So in all likelihood, if we're still growing jobs, we're probably not decreasing in our GDP.
Got it.
But the likelihood of these Fed rate hikes is going to
constrict something, right?
Constrict something, and most people think it's actually going to be commercial real estate.
I could see that, right? Like people are working from home more now.
Yep.
There's not as many people in offices. I can speak from our own experience. Like we downsized our office because nobody wanted to work in the office anymore. We didn't need as much space as we needed. You kind of see that on the ground, right?
Yep.
We kind of just see that happening. So you think that's going to be like the spark?
I think it could be.
Because usually isn't it like an igniter that kind of puts people into
and you could see the
housing did in 08 or 06
right.
or whatever.
Because what's going to happen is that you have so many, like if you own commercial real estate, you likely have financing on it, and those financing terms renew every 5 years, 3 to 5 years.
Right. So I did see a stat somewhere like how many trillions of dollars of, I think it was like $5 trillion in real estate is coming due by 2025.
Yeah. That's a lot.
That's a lot of notes, right?
Yeah. And so when you think about the value of the commercial real estate, it's going to drop,
right?
Because there's less people having occupancy in it, and there's going to be less ability for those people to refinance that debt.
I was talking to one of my buddies who's not in real estate. Actually, he owns apartment buildings, but he was saying, we were talking about the business of converting old office buildings
Right. Yeah.
Because one, you have a short commercial real estate side of things, right? And you have not enough homes for people to live in.
Mm-hmm.
We have a short supply
Yep.
of residential homes, and it's like, I bet anybody who's getting into that market right now and starting to look at these big office buildings and stuff like that and converting them to condos is probably going to do pretty well over the next few years, right? I mean, I was like, man, I'm gonna start looking into like some investment opportunities.
Yeah, right.
You know, sorry, I didn't mean to take us off.
No, it's
topic,
good. I just think, when you start we've talked about a lot of different things here.
Yeah.
Is like when you start packing these things on to each other, is that I guess what I would do is I would probably skew towards the side that we're not going to have a soft landing, that we're likely going to see. Yes, that's my gut feeling is that, I just think something's going to break at some point along the way.
And that's like those few regional banks collapsing last year. They kind of felt like that might have been the spark, but it wasn't.
Yep.
We just kept kind of chugging along.
Yeah.
But you think the commercial sector is kind of the thing that's going to break the camel's back?
Could be the commercial sector. It could be, all of a sudden the consumer dries up here and says, we don't have the spending ability anymore.
It's an interesting take on it. I mean, I'm with you and on the side that I'm like, eventually this has got to, like, the stock market's crazy.
Yeah.
I know tons of people that have gotten laid off that need jobs. Like, I'm like, it just doesn't make sense.
It doesn't.
Right? There's a lot of frictional unemployment. Like I'm just like, I don't understand how you have like these two grossly different realities going on at the same time.
Yep.
And I feel like there's going to be some kind of equalization and balance that comes. And what do you think on as far as like time frame goes?
I do think we're probably looking towards the end of this
24?
year. End of this year.
Or beginning of 25.
Yeah.
Stay alive to 25.
Exactly.
I kind of agree with that. I feel that. I hear guys on TV all the time that are saying that, this is going to be a soft landing. We're going to be fine. Drop market's great.
Yep.
Do you think that they're just kind of out of touch and they just don't know they don't see the street like we see the street?
Yeah, I do. We see, we saw people getting into their mortgages and, when we were refinancing, people were like well under like $3,000 mortgage payments.
Yeah.
And now they're at $4,000 and $5,000 mortgage payments.
Yeah, it's huge.
It is, it takes a lot out of the economy.
Yeah, like if you're for just to spend on a home.
Yep.
For sure.
Yeah.
I mean, obviously those numbers are skewed, right? You still have all those people that are sitting at the low interest rates that are not doing anything. And really, I got another really good question as we're talking about this. So, like, as you see rates come down, what do you think that point is where the rates like around like 4.5 or 5%, where you can actually get people off the fence that are at 3 that are sitting in their houses that they refinance in 2020?
Yep.
I mean, that's my personal opinion is I kind of feel like that range is like 4.5. Like if rates came down to 4.5, you might see more people decide that they're ready to move from one house to another.
Yeah.
And give up their 3% rate and move to something that's a little bit higher in interest rate for a new house. What do you think?
Two things. First off, I don't know if you've heard this stat either, is that for every 1% drop in interest rate, 5 million more households get into the affordability range to be able to buy.
And those are just people on the sideline.
Yeah.
Like they don't already own a house.
Correct.
They're just waiting.
Yeah. So like if the rate is 7% and the rate goes down to 6%,
right,
that's 5 million more households that could buy a house.
And that's just based purely on
affordability. Yeah.
Like they don't qualify for what they want unless the rates are lower.
Exactly. But the second part of this is that I think there's the psychology of a 4% handle.
Yeah.
So it could be 4.875.
Right.
And I think that would be enough for that consumer to be, for that consumer to be like, 3%, 4%, okay, 1% more.
Okay, and that's what the psychology.
I think that's the psychology.
So as soon as it hits the 4s, it's like game on. And I'm just talking about the people that already have houses. Now you're talking, going from 6 to 5. You're talking about, and this is 5 million people across the country.
Yes. Yeah.
So 5 million. So if we are dropping, we were at 7s, right? Now we're kind of in the 6s. So now we're going to be in the five. If we get to the fives by next year, we're adding 10, 15 million more people
Yep.
to the funnel of people that are going to start buying houses.
Exactly.
And then with a 30% decrease in loan officers availability, anybody that survives the 2024 is actually going to be picking up that fair share of the business, right? So the key is just to get through to the other side.
Exactly.
Loan officer, all you loan officers out there listening, make it to 25.
That's right. That's right.
Probably going to see an uptick in business. So beyond that, I was just meeting with some clients today and the future of the market, and we were kind of, because they're in the same boat. Like we sat in my office and we talked about, they're like, we have a 3% interest rate, but we want to downsize. I think our mortgage payment would be less. I'm like, I don't know. We'd have to look at the numbers, right? But it's one of those things where it's like, I kind of lost my train of thought. Like, do you feel like it's going to just land, the future of the market's going to land at and just kind of hang around that 4 to 5% range? Is that like what we're looking at for the next like 5 years? Because the conversation I had with them was like, I said my general take on it, not that I have a crystal ball, but is kind of like, I don't think we're ever going to go back to 3. I think 8's kind of out of the question. I think 4 or 5% is kind of the range I think we should naturally be sitting at. What do you think?
Yeah. 6%, if you kind of go back, historically, 6% is kind of a good historical 30-year mortgage.
Going back to what, the 60s?
Yeah. Yeah.
Go back to like the 1960s, like 6% is kind of them in the average.
Yep.
So we're pretty much sitting at the average throughout the last 50 years.
Pretty close.
Right now.
Yeah. Maybe a little over it, but
people just need to be a little bit more comfortable with
yeah, I mean, when you think about what your reality was, is that all of our reality was that rates were 3 and 4%.
Well, you know what all the young people say, right? Well, rates were 10 or 12% in the 80s, but a house only cost you $50,000.
Yeah, right.
Right? You heard that?
Yeah, yeah.
It's like, well, inflation is a thing.
Yep.
Right? And so, do you think there's like a little offset to that? When I hear millennials or younger people talking about like, well, houses only cost $50,000 and it was affordable then. So I think the offset, this is why I've come to my conclusion that we should probably be somewhere around 4 or 5.
Yeah, I mean, when you also throw in there like what people are compensated today too.
Right.
That's
people were not making as much money.
Exactly.
Yeah.
Exactly. Yeah. So I think we're probably 5%, low 5% would really charge this market up to a.
That would be where we should be at.
Yeah.
Historically.
Yeah.
For like in a normal market, right? We're not going COVID low.
Exactly.
We're not going, bounce back, pendulum swing the other way.
Yeah.
Inflation.
Healthy, just a turnover
5%.
of buyers and sellers.
I'm on board with you on that, Dirk. I think like 5% is probably a pretty healthy market interest rate. I think you'd have people moving around.
Yeah.
If we dipped into the 4s and the psychology would kick in for people to change houses.
Yeah. Well, that's the thing, is that we need to unstick this market.
Yeah.
And what is it going to take to unstick the market?
We as a country,
yeah, I mean, we as a market, let's say that.
Being in the real estate market.
Yeah, because right now you've got way too many homeowners that are like
kind of want to move but won't move.
Yeah.
Interest rate's too good.
Or that they can't afford to move.
Yeah.
Or they can't
afford it.
Yeah.
Yeah, right. Because they're just outside of that qualifying.
Exactly.
Their debt to income ratios are too high, right?
Yep.
Moving up. Do you have anything else you want to add to the market conditions? You know what we should talk? We haven't really talked about is what mortgage banks are doing, like big servicers are doing, to inflate their books and give more servicing value to the portfolios of mortgages they have now to offset their. This is a big topic. We talk about this a lot, and I kind of wanted to get this on the show a little bit with you because I know you're really passionate about this as much as I am. I'm like, F these.
Yeah.
F these guys are breaking the rules. When's the shoe going to drop? So can you do everybody a favor and kind of talk to that?
Yeah. Let me try to give it some context.
Yeah, that's what I want. I want you to give it some context.
We all went through the Great Recession. We know what happened in the mortgage collapse market.
Right.
What happened in the mortgage collapse market was that there were a group of investors who shorted
Big Short.
The Big
If
Short.
you never watched The Big Short,
Go watch it. It's a great
The
movie.
Big Short.
Great movie. But there were packaging of bad mortgages in with good mortgages.
Right.
And The Big Short revealed that they're like, oh, we found the smoking gun here.
Right.
And so when those bad loans started to foreclose and deteriorate, that's what destroyed the entire lending portfolio.
Right.
Fast forward to today.
Yeah.
That's where I think that this market is going, is that there's an accounting ability for somebody to put their thumb on the scale and say, hey, you know what? We did all of these loans through 2020 and 2021.
Right.
And we own a bunch of these loans at, 2.5% to 4%, let's say. And they're saying, well, those aren't going to go anywhere. So we value those. Those are going to stay on the books for a very long time.
Right. Which does hold a little bit of validity.
Exactly.
Yeah.
But they're also not paying a big yield back on them. Then interest rates start spiking up. And with those rates start spiking up, now all of a sudden, lenders who retain the servicing of their loans after they're closed are saying, wow, we've got loans that are 7 to 8% on our books. Yeah. Those things have a huge value to them. Right. And, instead of, let's just say they're worth 100 cents on the dollar. Right. What the accounting team is saying is like, well, actually, those are going to as interest rates drop down, right, those are going to be huge valuations on our books. Right. So they might value them at 125 cents on the dollar instead of what they're really valued at. And then the problem becomes when all of a sudden that 8% loan gets refinanced down to 6.5%, that's no longer on their books, and they overvalued that to their investors.
And so the value comes due at that point.
Yes, yeah. So they have to realize a loss on that revenue because they're not paying that revenue stream anymore.
Right, right.
So then all of a sudden you kind of have this.
So what you're saying is, do you think banks, servicers, these big servicing companies, are valuing their new mortgages at the higher rates at the same value that they're giving their older ones that are at the lower rates?
No, they're valuing them at a higher value.
Even though they know that they're going to get...
They don't know that. Well, they think that these rate environment is going to stay high for longer.
They're betting on the fact that rates aren't going to come down.
Better said. Yes.
Okay. So they're like, we're going to hold on to these for a while because people aren't going to refinance because rates are going to stay high for a while.
Yes.
Is what they're saying. Yeah.
And that if they're wrong, then they're way overvalued in their valuation and their book value.
Group of loans that they've done in the last couple of years, they're saying these are worth a lot of money. They're high interest. They're going to not go anywhere because the economy is not going to go into recession. Mm-hmm. We're going to stay fine, and rates aren't going to come down, and they're not going to be able to refinance out of them.
Or we'll refinance them and we'll keep them on our books is another.
Do they still take a loss if they refinance them on their books?
Yes.
Or they just
not as big. Yeah, not as big.
Because they're retaining the servicing and they fold it back under their servicing.
Exactly.
So it just replaces itself.
Yep.
With a little bit of less income.
Yep.
Because the rate's lower.
Yes.
Got it.
So what they can do, these mortgage servicing companies, then with that higher book value of their servicing, what they can do on the other side of it is that they can put their interest rate pricing at a lower premium to induce more people to actually use them to earn those transactions, because they have more value on the servicing side, and they can offset that with a lower interest rate that they can offer. So that way they're basically continuing to feed the beast of servicing by having more loans coming in.
So what do you think is the spark that's going to cause that to collapse? I guess you know what I mean. It's like paying Peter or taking from Peter to pay Paul, whatever that saying is.
Yeah.
We're just like recycling the same money
Yeah.
and overvaluing it. I mean, how does that end? I mean, in your opinion,
In my opinion,
anything that we talk about is obviously our opinion.
Totally. Yeah, this is totally speculation on our part.
Yeah, exactly. So what do you think? What do you think?
I think you and I have talked about this in the past.
Totally.
And it's like, and I think that, if rates happen to drop
Super fast.
like a lot super quickly, like if all of a sudden we dropped 1 to 1.5% in interest rates.
Like if we go into a big time recession.
Yeah. Or something geopolitical could happen as well.
Right.
Those are things that we haven't talked about that are market related.
Yeah.
So if you had rates, let's just say rates are in the high 6s today.
Yeah.
And they drop down to the mid 5s in a 4-month window or 6-month window. Now all of a sudden you have this massive refinance market. Everybody if you're sitting at a 5.5% interest rate and somebody's got a 6.5 to 7% interest rate, they're going to refinance.
Right.
So that's going to wipe out those
higher rates.
Yeah.
And they're only going to be able to retain a certain amount.
Yeah, because there's been so many, there's been 8,000 mortgage brokers in the state of Colorado alone.
Yeah, so
there's not enough people there to.
Well, they can't.
They can't retain them.
The staff.
They don't have the staff to retain it.
To do the work to get the loans bought or originated and stuff like that. So they're going to lose like a certain portion of that.
And the consumer is going to be way confused over what is actually being offered out there.
Right. Well, I think the consumer is always way confused.
Yeah.
What's being offered because people always put out these like teaser rates with points or whatever.
Yeah.
I mean, it's kind of sad sometimes that people do that. I think that our whole group has always been pretty straight shooting as far as like what we think reality is, and not like we're not really salespeople. We're more like educators. Like,
exactly. Helping people make decisions.
Yeah. Exactly. So that should be interesting. I mean, we've kind of talked about like what could cause a recession if there's going to be a recession. Then we just talked about the mortgage bonds and marking up people's portfolios and the results of there is a recession. What happens? I think we've just covered full circle and kind of like what we right.
There's a lot of territory.
Yeah, we did cover a lot of territory, but we kind of came back to it, right? Like, hey, this is what could happen. Like, and I don't think people are necessarily going to lose their houses because they have mortgages and people will buy those mortgages. They're if a company collapses, there's going to be somebody there to pick up that paper.
For sure.
Area. It's not like that, but it's like for us, it's interesting because we're in the industry.
Yeah, I think it is. It's an industry question more than it is. I think a global consumer problem.
Let's talk about home buyers now entering the market. Like, what do you feel? How do you feel about that? This is kind of a question I asked Ian. Like, what would you say to any like future new homeowners coming into the market? I know it's really scary, right?
Yeah.
People are like, these interest rates are high, payments are high.
Yeah.
What are you telling your clients? Like, what are the conversations that you're having?
Buy now. Literally, it should be that simple in my mind.
And why?
Because the availability of real estate right now is so low. And I mean, we know this, both being loan officers and branch managers. We see this massive amount of pent-up demand of buyers that are sitting in our queue just waiting for that rate to drop or just waiting for that opportunity or the affordability or just a house to pop online that fits them.
So you're saying if you can afford it and you can
cover
the mortgage payment,
buy it.
It's not going to hurt you financially. This is a good time to get in to real estate because you have less competition.
Yep.
Yeah.
And again, for me, it all kind of goes back to the economics of it. Right. If rates drop, we're going to have more buyers in there that are going to go right back into trying to buy as many houses, and we're going to have multiple offers. We're going to have the prices of real estate going up and up and up again.
I literally just said this to these clients I was talking about earlier that I met this morning. I was like, well, do you want to pay a higher interest rate now, or do you want to pay $50,000 extra for your house?
Yeah. That's
next year.
the perfect way to say it.
I mean, it's kind of right. It's kind of one of those things. It's like if you can afford it, it's a good time to get in and get the house you want, and you're not gonna have to compete.
Yeah.
And then you'll just have to wait and see if rates come down and refinance. So there's no guarantee for that, but it's like the competition's less, right?
Yeah.
Yeah. And so what else are you? Is there anything else you're telling your clients right now?
No, I mean, it's just, again, if you can get in, go for it. We've started talking about this cash program.
Right.
That really helps out with improving the liquidity of the marketplace.
Right.
And I do think that that's going to be a major component of the market moving forward in the next couple of years.
You kind of feel like that's us doing our part to loosen up this market in our local.
Yeah. I mean,
it takes a village. Kind
totally.
Of or no, not think globally, act locally.
That's right.
We're doing our as much as we can locally to free up our real
That's
estate
right.
market.
We're just trying to recycle as much as we can.
That's funny. Beyond that, you have anything else you want to talk about?
That's great. It seemed like it just flew by.
Doesn't it?
Yeah, totally.
It's like one of those things where you're just like start talking with a friend, and all of a sudden you're like an hour goes by, and you're like, wow, that was an hour.
I think we're just really lucky to be in this business. You and I have been pretty fortunate to come through this and also have the clientele that we have.
Great clientele and great real estate partners.
Yeah, and the best part of this,
a great team.
That's the best part.
Ian and I got really deep a little bit in the previous podcast just about our teams and how grateful we are and how we're like a family,
Yeah.
And it's like, and even clients come in and they feel like they're, Ian had said it. He basically said, clients come in, I want them to feel like they're coming into my house and my kids are there and Jill's there and we're all there to welcome them and our clients, our realtor partners, our team. We're really fortunate to be where we're at.
Yeah.
And you as a partner.
No, that's what I was going to say. The four of us as partners. Yeah. I mean, it really is. I mean, you think about how many other people can't have a 4-pack of partnerships because there's always going to be some sort of personality. I mean, we've all just gelled.
We're going to do a future podcast where the four of us sit down and kind of go through all this stuff, and I think that's going to be a really fun one to do. I'm looking forward to that. So when we get taught out here, it'll be really fun for all of us to sit down and kind of go through that whole partnership thing.
Totally.
Just because we have so much history between us, and we've been doing this together for so long, it's going to be really fun to get into that conversation.
Yeah, it really will.
Well, Dirk, I want to thank you.
This has been great, Blue. Thank you.
Yeah, man. Of course. Thanks for being part of my second podcast.
Yeah,
that's pretty cool.
Happy to.
I'm excited. Going to start. The third one's coming up in a couple days, and
you do such a great job at this already. I mean,
know,
it's just
right?
I think this is going to blow up for you.
I know it's supernatural, isn't it?
Yeah.
I'm really excited, and thanks for being a part of it. And I'm sure I'll probably have you back on at some point.
Sounds good.
All right. Thanks.
Thanks.